Next week is light on the economic calendar in terms of data. LCG Analyst Ipek Ozkardeskaya discusses what she'll be looking out for.
Well, it's going to be a light economic calendar next week. The most important data is going to be the GDP growth data out of the US, the UK and Germany. It's going to be about the fourth quarter, so fourth quarter last year has been a difficult quarter and we do not expect any upside, any surprise on the upside. The market, I guess, is ready to take a soft read both from the UK and the US and even Germany. So we do not expect to have any major surprises on that end. We have seen Fed minutes mentioning the slowdown in China at its latest meeting, and it seems that another rate hike from the Fed is now out of the calendar, at least for the 2016. It looks like it has been a one and done rate hike in December. So now the market is pricing a softer US dollar, and this is where we enter. We believe that we enter into a softening US yields and US dollar phase.
With the Brexit at the forefront of discussion as of late, Ipek shares her thoughts on what this will mean for the UK economy.
Well, it's difficult to make something out of it. There's one thing which is sure, that the uncertainty looms. We have seen David Cameron going to Brussels this week to talk about the UK conditions in order to stay in the European Union. So we are going to have more clarity as he comes back, so we didn't hear any news just yet. But the market has been very volatile. We lacked direction in the UK markets this week, in FTSE, but also in pound. Pound has sold off aggressively this Friday morning as the UK and EU negotiations extended to a second day. So now we are at this 140, 145 range, and before any news, any concrete news, we do not believe that we will be seeing a sustainable breakout. So 143.55 level is technically a good pivot. It is to watch. If we can surpass this level, the pound may go to 145 levels. Below the failure to break 143.55 to the end of the week, so a couple of hours from now, could keep the 140.80 levels on scope and even 140. Yet, with the US dollar softening, the 140 may be a good level for those looking to buy the dips in cable.
We've seen dollar-yen go below the 113 mark this week. So Ipek discusses what the Bank of Japan has been doing since their negative rate strategy and how and if this has actually helped weaken the Japanese yen.
It's very sad for the BOJ. The last time BOJ said that it's going to launch this negative rate strategy, since then the yen just kept on appreciating, and now we are just below 113 level against the US dollar, and it seems like the BOJ is losing control on this currency, and especially the risk of environment does not help. The lower US yields does not help, and all the conditions that are out there are not favorable for a weaker yen, and that's a problem. We have the Japanese CPI coming next week, so the inflation is expected to be flat, so the deflation is still around the corner. There is one question: what's left to BOJ, because now they are buying a huge amount of bonds. The eligibility of these bonds is the question. The pool of bonds is drying right now, so maybe there may be some more some new strategies in order to give a boost to this market, because now it looks like it's looming and it is not in favor of the BOJ nor the PM Abe's expectations or will to enhance the inflationary outlook in the country. So we may see this dollar-yen falling even more to 111 levels that we have seen a couple of weeks ago, or even 110 mark may be in game for next week if something convincing the market is not done, actually.
We have seen gold gaining again this week, so Ipek shares her final thoughts on key levels to watch for gold.
So interestingly and happily, actually, gold is back in the game as a risk haven asset. We see like a huge amount of cash in the market right now, and we can see that investors are sitting on this cash and increasingly moving to gold in order to hedge the risk of risky assets. We have seen that the 4-day correlation between the S&P 500 stocks and the gold going to minus 45%. This is good news for those looking to hedge their positions with gold. Now we are about 1200 levels, and we may see an extension to 1250 or 1260 levels for weeks ahead if the risk-off environment remains and the conviction of the market remains at these low levels.